Very good evening, friends. In this video, we will go through Accounting Standard 11, effects of changes in the foreign exchange rates. One word of caution is that in this video, I will not be discussing around the part of the standard which deals with the integral foreign operations and the non-integral foreign operations. The reason is that has been separately covered under the topic branch accounting. So you may refer the concepts there in that video. So I don't want to repeat the video here. So in this standard, I'm going to discuss all other portions of AS 11 apart from the one which deals with the foreign operations. Okay, right. Now, we need to go through some of the key definitions which are used in the standard. When I say exchange difference, what is the real meaning of exchange difference? It is a difference resulting from reporting the same number of units of a foreign currency in the reporting currency at the different exchange rate. Okay, because you may there is bound to be a difference between the two exchange rates. So what is the exchange difference? So for example, when you buy an asset, it is at 45 rupees USD, and then if you 2 months down the line, if you want to make a payment, it has moved up to 48. That 3 rupees is the exchange difference. So exchange difference is a difference resulting from the reporting the same number of units of a foreign currency in the reporting currency at a different exchange rate. So when you import a machine, let's take $10,000, right? When you import a machine worth $10,000, which means we need to pay $10,000 after a 2 months time period. Assuming the credit period is 2 months, we need to pay $10,000 after 2 months. So when you actually bought the machine on credit, the exchange rate at that day was 45. But now after 2 months, right, it becomes 48. So that 3 rupees difference, that is the exchange difference, which means in this case, we have to pay more. Okay. Now, foreign currency is a currency other than the reporting currency of an enterprise. For example, if I am in India, INR is a reporting currency and my USD is my foreign currency. Then we have something as foreign operation, which I said I've discussed in a separate video. But anyway, just to give an intro, foreign operation is a subsidiary, associate, joint venture, or a branch of the reporting enterprise, the activities of which are based or conducted in a country other than the country of the reporting enterprise. For example, if I'm in India, if the HO is in India and I have a branch at Singapore, right, that is called a foreign operation. It could be a subsidiary, it could be an associate, it could be a joint venture or a branch, it could be anything, right? And within that, you have an integral foreign operation as well as a non-integral foreign operation. When I say integral foreign operation, it means it's wholly dependent on the head office. So it is a logical it's an extended arm of the head office or we say the reporting enterprise, right? Reporting entity. Whereas when I say non-integral, it's more like an independent branch. They have their own set of rules. So that's important. Okay, but in either case, whether it's integral or non-integral, you need to convert a trial balance which is in the foreign currency into the reporting currency, and you will have some forex foreign exchange differences, and you need to record them accordingly, treat them accordingly. So how do we do that? We have discussed in a separate video on foreign branches under branch accounting. Please view it there. Key definitions: forward exchange contract means an agreement to exchange the different currencies at a forward rate. For example, same example, $10,000 worth of machinery I am actually importing, right? It is 45 rupees. The exchange rate on the date of the transaction when I imported was 45 rupees. Now 2 months time is given to me. So I have a choice. Right? I am expecting that the rupee to depreciate, and from 45 it might go up to 48. So to avoid that, I am going to the bank and I'm fixing a rate which is called the forward exchange rate at 46. So if the bank is okay with that, then I end up paying only at 46 and not 48. If the actual after 2 months period, if the actual rate is 48, right, I have already hedged and I'm going to pay only 46. This is a forward exchange rate. That's a forward contract. That's a forward exchange contract entered between us and the bank. What is reporting currency? Reporting currency is the currency used in presenting the financial statement. So if I am in INR, if I am in India, INR is my reporting currency. two other important items which are very important is monetary items and non-monetary items. What are monetary items? They are money held and assets and liabilities to be received or paid in fixed or determinable amounts of money, cash in hand, cash at bank, sundry debtors, sundry creditors, bills receivable, bills payable. All these things are monetary items. Then what are non-monetary items? Anything which is other than monetary is non-monetary. For example, fixed assets, land and building, plant and machinery, all things are non-monetary items. Okay. Now comes the important part. How do we recognize in a foreign currency transaction? How do we do the initial recognition? First time. For example, I'm importing a machinery worth $10,000. How should I record? A foreign currency transaction should be recorded on initial recognition in the reporting currency by applying to the foreign currency amount the exchange rate between the reporting currency and the foreign currency at the date of the transaction. So today's date, if I'm importing a machinery worth $10,000, right, I cannot record it as $10,000 in my books. It has to, mine is a reporting currency. I'm in India, so I have to record in my reporting currency, which is INR. So I have to apply to the $10,000. What is the exchange rate between the reporting currency and the foreign currency? INR is a reporting currency, USD is a foreign currency. What is the exchange rate between the two? Assuming 45 rupees is the exchange rate, just an example. So I have to apply $10,000 into 45, which is 4,50,000. That is the total value I'm going to record in my books. So $10,000 is the forex amount, foreign currency amount. The INR, the corresponding INR amount is 4,50,000. Okay. For practical reasons, a rate that approximates the actual rate at the date of the transaction is often used. If you do not have, right, an exchange rate on the date of the transaction, you may use an average rate. That's okay. You may use a weekly rate or a monthly rate. That's not an issue, so long as it is not significantly fluctuating. But if you find that the exchange rates are fluctuating significantly, then you can't use the average rate. You have to find out the rate, the rate which is prevailing on the date of the transaction. Okay. Now, this is the initial recognition part. So let's, in our example, it was 45. What happens at the balance sheet date? So if you have a foreign currency monetary item like sundry debtors, sundry creditors, whatever may be, you need to translate at the closing rate, with an exception where the closing rate may not reflect the amount likely to be realized or dispersed. So use the closing rate always. What about non-monetary items which are carried in terms of historical cost denominated in a foreign currency? In our case, we bought a plant and machinery for $10,000 at 45, which is 4,50,000. What is the exchange rate prevailing on the date of transaction? We have to use that rate only, which is typically at cost only. Okay, not the closing rate. Exchange rate prevailing on the date of transaction. Very important. Okay. Which means if this is for a non-monetary item, but for a monetary item, it is always at the closing rate. So in my example, if you bought a machinery on credit, you would have said plant and machinery account debit to creditors for plant and machinery. Right? So plant and machinery, it's a non-monetary item. So that you always, that will not change. It will always be at 4,50,000. But what about the creditors? Creditors initially you recognize at 4,50,000, but it is a monetary item. But you have to recognize at the closing rate. Assuming closing rate is 48, then it becomes 4,80,000. So the difference is 30,000 there. So you may not have an exchange difference in the non-monetary item, but correspondingly you may have an exchange difference in the monetary item. Let's be very clear. Look at an example. I said plant and machinery account debit to sundry creditors, or let's say creditors for plant and machinery. So the plant and machinery is a non-monetary item, and I said you at the balance sheet date you need to use the exchange rate prevailing on the date of the transaction. What is that? When the asset was purchased, you have to use that rate only, which is typically at cost. But what about the monetary item for that, which is a creditors part? You have to use the closing rate. So when you bought at 45, now if the rate is 48, you have to account at 48 only, which means there's a 3 rupees gap. That is going to be the exchange difference. Now, what about non-monetary assets which were determined at fair value or other similar valuations like NRV? Then you have to use the exchange rate prevailing at the time the values were determined. Whenever the fair value was determined, what was the exchange rate prevailing on that day? You please use that rate. So now if you see, there is going to be a problem in terms of an exchange difference. How do you recognize the exchange differences? Exchange differences arising on the settlement of a monetary item or on the reporting of an enterprise monetary items at rates different from those at which they were initially recorded during the period or reported in previous financial statements should be recognized as an income or expense in the period in which they arise. Okay, that's important. So first choice, you have to take it to P&L. In my case, 45 rupees was the liability, 4,50,000. Now, after 2 months' time, it becomes 48, which means I have to pay 3 rupees more. So 10,000 into 3, 30,000 is the loss. That loss I need to debit to P&L account. Remember, when we bought the machinery, it was at $10,000 at 45 rupees. So 4,50,000 is the actual liability. Now, 2 months down the line, it is 48 rupees, which means I have to pay 4,80,000. So how much am I paying extra? I'm paying 30,000 extra. That exchange difference will be reported as a loss or expense in my account. Similarly, if the rate is 44 instead of 45, I gain 10,000 rupees, right? So that will be taken as an income. Okay, but what is the exception? That exception, it relates to a non-integral foreign operation. It says exchange differences arising on a monetary item that in substance forms part of an enterprise net investment in the non-integral foreign operation should be accumulated in a foreign currency translation reserve in the enterprise's financial statements until the disposal of the net investment, at which time they should be recognized as income or an expense. So if you have a net investment in a NIFO, which is non-integral foreign operation, and if you have an exchange difference arising on account of a monetary item, you can't take that to P&L directly as income or expense, right? Instead, that is getting accumulated. All those exchange differences will get accumulated as part of the FCTR, foreign currency translation reserve, and upon disposing of the net investment in the NIFO, that's the non-integral foreign operation, at that point appropriately you need to take it back to income or expense. That is important. Okay. Now, there is one relaxation which is very important when with regards to long-term foreign currency monetary item. What is long-term? More than 12 months. For example, you're taken a 3 years loan or a 5 years loan. That is long-term foreign currency monetary item. Now, using that loan, you could have done so many things. You could have used that loan to buy a depreciable capital asset, or you can use it for some other purpose also. So, if there are exchange differences there, how do you deal with that? Right, para 46A of the standard, it gives you a relaxation. And in fact, there were two notifications which came into force. One was in 2009 and other was in 2011. There were two notifications which were given. What they say, now remember the earlier discussion, whenever there is a difference in the exchange difference which relates to monetary item, we said we will take it to P&L account as an income or expense. But if that monetary item is long-term in nature, if it is a long-term foreign currency monetary item, and if you have used that long-term monetary item to fund or to purchase a depreciable capital asset, the option given to us is what? You can actually adjust the exchange differences, right, to the cost of the asset. So if it's an exchange gain, you can add it to the cost of the asset or exchange. So any exchange differences, it could be a profit or a loss, you need to actually adjust it as part of the cost of the asset, and then you please depreciate the asset accordingly after accounting for the exchange differences, which means you cannot take it to P&L account. So what they say, initially, if you have already taken to P&L account, now I'm giving you an option. We are giving an option, right? In 2009, they came up with a notification that if you have already taken that amount, that exchange with the P&L account, you may reclassify it and actually add it as part of your capital asset. You can adjust that exchange difference as part of the capital asset, and then you can depreciate it. So 2009, that notification was given, and the time given was till 2011. In 2011, another notification came extending the time till 2020. Okay, so this is the big difference there. The small adjustment, small relaxation given to us in terms of 46A. So otherwise, by default, any exchange differences which relates to a monetary item, we would take it to P&L account as an income or expense. But the only relaxation is para 46A. If it is relating to a long-term foreign currency monetary item, and if that is used to buy or acquire a depreciable capital asset, then the exchange differences, instead of taking to P&L account as an income or expense, you can adjust it in the cost of the asset and depreciate the asset accordingly. So that option is given to us. It is up to the company whether they want to press this option or not. But if the long-term foreign currency monetary item is not used to fund or purchase a capital asset, a depreciable capital asset, but it's used for some other purpose, then the exchange differences, you have to accumulate it in a foreign currency monetary item translation difference account. That is important. And you have to amortize it over the balance period of such long-term asset or liability. Right? So if you're using for other purposes, then you have to accumulate the exchange difference in a foreign currency monetary item translation difference account in the enterprise's financial statements and amortized over the balance period of such long-term asset or liability. Right? Okay. Now let's talk about forward exchange contracts as well. There are two purposes of which you can enter into a forward exchange, a genuine forward exchange contract, and which is not intended for trading or speculation purposes. The other criteria could be that you enter into a forward exchange contract for the purpose of trading or speculation. So we will now deal with the principles for forward exchange contracts which are not intended for trading or speculation purposes. Now, in which case, first thing, the premium or discount arising at the inception of the forward contract should be amortized as an expense or income over the life of the contract. So if the forward contract is not intended for a trading or speculation purposes, point number one, the premium or discount arising at the inception of the forward contract should be amortized as an expense or income over the life of the contract. And any exchange differences which are arising on a forward exchange contract should be recognized in the statement of P&L in the reporting period in which the forward rates change. That's important. And any profit or loss arising on cancellation or renewal of such a contract should be recognized as income or expense for the period. So if you see, if you look at these things, normal forward exchange contract which are not intended for trading or speculation, the ultimate recognition is in the P&L account. Right? If it's premium or discount at the inception, that is amortized as an income or expense over the life of the contract. Right? If it's a 3 months contract or 6 months contract, over the life of the contract, you need to debit or credit the P&L account. If you have an exchange difference arising on a forward exchange contract, this is premium or discount. This is exchange. These two are different. This is premium or discount. This is exchange differences on a forward exchange contract. That should also be treated in the statement of P&L as an income or exchange or the expense. You may also encounter a situation where these contracts are cancelled or even renewed. Right? What is cancellation or renewal? Renewal is extension. Cancellation is you're just going to cancel the contract. You don't want the contract. Then, obviously, you already entered a contract with the bank. If you want to cancel it or renew it, obviously there is going to be a profit or loss. That should be recognized as income or expense for the period. So there are three different patterns which are emerging for a forward exchange contract which is not held for trading or speculation purposes. Number one, premium or discount. That's one. Exchange differences is number two, and any profit or loss from cancellation or renewal. Right? If you look at the three, the one single point which attaches all the three is that the whole treatment is in the statement of P&L as an income or an expense. But what about other contracts like forward exchange contract which are held for the purpose of your speculation or trading? Now what they say, simple, you need to calculate a gain or loss, because since it is for speculation or trading, because you would have already contracted a rate, right? You have something called a contracted forward rate. They say a gain or loss should be computed. So we need to compute a gain or loss. How do we compute? By multiplying the foreign currency amount of the forward exchange contract by the difference between the forward rate available at the reporting date for the remaining maturity of the contract and the contracted forward rate, right? That is the gain or loss. So you already have a contracted forward rate. You need to find out or work out a forward rate, right, for the remaining maturity of the contract. So if the contract is a 6 months contract or a 9 months contract, for that example, let's say 6 months contract. If 4 months is already over and 2 months are left, you need to find out the forward rate for the balance 2 months. You please compare it with the contracted forward rate. The difference between the two is a gain or loss, and that gain or loss should be taken to the P&L. Again, it's very simple. You take it to P&L, but the only difference is that unlike the earlier forward contract, which was not held for trading or speculation, right? Here, premium or discounts, they are ignored. They are not recognized in the statement of P&L. They are not taken consideration at all. They are just ignored. Any premium or discount on the forward exchange contract, it's not recognized separately. So when you get a problem around forward contracts, you need to first classify, is this a contract which is held for not for trading, held for a very generic purpose, right, and is not held for trading or speculation, or is this a contract which is held exclusively for the trading or speculation purposes? Once you are thorough in that classification, apply the rules, and anyway, we'll be solving a lot of problems on this, and I will be taking you through the standard again during the solution, during solving the problems also, and things will be very clear. Okay. So that's the end of the video, and very important standard from an exam perspective. The reason is, this is all about foreign exchange. So you will get a problem not only in accounts but also in your auditing paper as an accountant. And as an accountant, how will you audit this, or just check whether the accounting treatment done by the company is right or not. So AS 11 is a very important standard. The reason is, you have foreign branches which are getting covered here, and this from a probability perspective, in my view, whenever you get a question from branch, I would say 50% or 60% probability should be a foreign branch. The balance is only your DATAS method, independent branches, or a stock and DATAS method. Those are very less probability. The first preference will be from a foreign branch, because that is getting covered under AS 11. So please focus on AS 11. Do not leave it a choice. Okay, it's a very important standard, very simple standard as well, but there are a couple of nuances you need to be very careful about. Thank you.